this idea of we're not attacking the philosophy of the Austrian econ or even the philosophy of the neoclassical econ, is we're looking at what are the fundamental principles. And we said, okay, we disagree on these two fundamental principles. And we'll, for the sake of this conversation, we'll just say the one: barter theory versus credit theory, or state credit theory of money, right? And we could say, okay, if you go down barter theory road, you end up with an Austrian or a neoclassical view, or if you go down state credit theory, you end up with something more like an MMT view. And the question then becomes, and I think this is the most important one, which we've just been discussing example after example, is what does the evidence support?
Yeah.
What does the historical and economic evidence support? And on team Austrian, on team neoclassical, on team barter, they're just like completely uninterested in looking at evidence and looking at historical or archaeological or anthropological or economic evidence, anything, right? And we're pointing out that the evidence supports the state theory of money, and we need to start there. Once we start there, we can say, okay, let's apply a philosophy, right? Let's apply, ethics or whatever, but we have to start at what is reality first. Like, what's the reality that we're working with that we're applying this philosophy and ethics to? And we're making the argument that the evidence supports the credit theory of money, not the barter theory of money.
Well, certainly
Yes.
that it's a historical fact that that the credit money has been a thing for as long as human civilization has existed. That's hard to deny, and and so that's where we're coming from. We have another comment from Carlos. Hey guys, so I've heard
Interesting.
the story about the creature from Jekyll Island, and I think fiat money gets a bad rap because of it. Was it really a maniacal thing that took place there? Yeah, that's the creature from Jekyll Island by G.W. Griffin, I think, right?
G. Edward Griffin.
G. Edward Griffin.
Here's the thing. I'll say this on the creature from Jekyll Island, and I've listened to lectures by J. Edward Griffin, and I made it about halfway through the book. I'll be honest, I didn't finish it. I made it about halfway through the book. Is that we're not saying that there aren't evil bankers. We're not saying that there isn't a secret Illuminati cabal that's trying to take over the world and exterminate everybody, and one of the ways that they do that is through economics. We're not saying that at all. What we're saying is because the people who tend to think that are working with the wrong rules. They're working with the wrong map of how things work. They come up with wildly false solutions. They come out with totally erratic solutions. And unfortunately, the creature from Jekyll Island is one of those things where I remember specifically from the book when he tries to explain equilibrium, which is to say, okay, Griffin gave this specific example in the book. I remember this. Is he said, okay, let's say you have a community. It doesn't actually matter how much gold is in the community, because if you have 1 ounce of gold within a community of 10,000 people, if you're able to put a little bit of ounce of gold and a speck of gold in each coin, the prices are going to reach an equilibrium where everything's going to work out, even if you have a small amount of gold versus a big amount of gold. Now, I've got 2 problems with that, at least. The first problem is I don't believe in this equilibrium nonsense. And the second problem is, so you're saying if the community next door walks over with another gold coin, blah, you just inflated everything by 100%. Right? You're just completely subject to the whims of some other community that can either take the gold out or put more gold in to completely disrupt what's going on. And so, in terms of the Federal Reserve itself, I think that there's a lot of people and the upper elites that really benefit from how the Federal Reserve works, but not the way you think they do. And the Federal Reserve has a lot of control over the economy and the banking sector, but not in the way that you think they do. I mean, we've gone over this in other shows where what was it? It was the Silicon Valley Bank, and was it like First Republic Bank or something like that? We looked at the balance sheets of what was leading up to these banks getting closed down, and what exactly the rules that they were breaking were the rules that they were breaking were, and it had nothing to do with this fractional reserve system, and it had everything to do with here's what the law says that the bank needs to do, because the entire thing is a legal process, not a physical commodity process. So with the creature from Jekyll Island, yes, there are evil people colluding to do bad things and to steal from us.
Yes.
In
So
terms of the way that the economy and the Federal Reserve and the banking system works, Griffin got it all wrong.
yeah. So there's a lot of people. There's a whole community around Creature from Jekyll Island, and even before that, the Austrian economist Rothbard. Mises, not even that much actually necessarily, but a lot of people have this. The Ron Paul movement have this laser focus on the Federal Reserve Bank and the fact that they lend money into existence out of nowhere, supposedly, and that they monetize the debt and all these things. We can clarify what these things actually are. They're not really what they think they are, in our opinion. But the Federal Reserve Bank. So before the Federal Reserve Bank existed, there were other banks in the U.S. that took on the role of the Federal Reserve. There was a first bank of the U.S. There was a second bank of the U.S. There was all the way back
I
to
think
the
the Fed
original.
is the fourth, isn't it? I can't remember if it's the third or the fourth.
Yeah, well, I'm just talking about there was a bank that was literally called the first bank of the U.S.
Oh,
and there
I
was
see. Yeah.
one called the second bank, and there was Alexander Hamilton. All these people were involved in those decisions in the early days. But the challenge was always that, okay, people have this currency that they transact with. How do we ensure at par clearing across states in this vast territory of the United States? And the one of the rather neutral tasks of the Federal Reserve is to just be a clearinghouse for all the different banks across the entire country, because it's
What
not easy.
basically making sure that a dollar equals a dollar no matter what bank that you're banking at, right?
Right, right.
Yeah.
Which philosophically and conceptually does make sense, right? If I earn money, if I've provided a value to someone that's worth $50, then that $50 should be $50 in the territory that claims to use the dollars as a system. And individuals can still, in individual territories, they can still adjust their prices according to standard of living, cost of living, etc., in the area. But when I transfer $50 from a bank in Florida to a bank in California, I want the number that I want to show up in the new bank is $50, right?
Right.
So that's something that the Federal Reserve makes possible, is at par clearing. And the Federal Reserve Bank, by the way, is not one bank. There is one
13 of them,
federal
something like that.
institution. There's 13 different reserve banks across the country, and the local banks are members of those reserve banks. And one of the things they do is obviously at par clearing. Now, the one thing that the Federal Reserve does do that we heavily criticize all the time on this show is the attempt to manage the risk-free interest rate, because they have their quarterly meetings or whatever, and then the chairman always steps on the podium and gives a speech, and the markets are laser focused on what he's saying. Oh my god, could the rates go up sooner than we thought before? This is complete nonsense, honestly. This whole focus on the risk-free interest rate as if it is some high impact economic variable that changes the alignment of factors of production, and that can increase or reduce inflation and or production, etc., etc. That is not really the case, and we've talked about this many times. When the Federal Reserve the common wisdom is that when the Federal Reserve cuts the rates, then they are permitting more inflation. When they raise rates, they
Because people are going to borrow more money from the banking system because it's easier to
exactly
borrow.
to
Yeah.
borrow more money because rates are lower, etc., etc. So that will increase inflation, and if they raise rates, then that will reduce inflation. But empirically, there's no evidence for this supposed correlation. People have tried to draw this conclusion over and over, tried to make the case for a correlation that does not exist. And Professor Werner the economist has also done this research, and he concluded, well, it actually looks more like the Federal Reserve happens to follow whatever the current rate of inflation is with their interest rate policy. If inflation goes higher, then the Fed starts raising the rates. And inflation starts going down, then the Fed start dropping the rates. We see this over and over and over. It is so boringly predictable at this point.
And then watching the rest of the economy freak out, be like, "Oh my God, they're doing this with the rates, and they're doing that with the rates, and
Right.
Peter Schiff just screaming it. They're raising the rates. It's gonna end. They're lowering the rates. It's gonna end. And it's just not that big of a deal.
Right. And when Trump was president, Trump was super proactive, stepped out and said, Powell, you need to cut the rates. And then Powell cut the rates. And then Trump came and said, you have to cut them more. It's not enough. And so Powell's like, okay, I'll cut them more. And now that Powell is cutting rates and Trump is not in office, Trump is upset about that. He's like, oh, he's just doing it to help Kamala. And he did it too soon. The inflation is still a risk, blah, blah, blah. So
it's all a distraction.
This topic is so loose and so foggy. Nobody really knows what they're talking about when it comes to inflation and interest rates. But the Federal Reserve proclaims in the current economic orthodoxy claims to be able to manage interest rates by adjusting this one dial of the interest rate. And by the way,
claims to be sorry, you spoke wrong. They claim to be in control of the inflation by adjusting the dial of the interest rate. That's what I meant.
Correct. And by the way, in fact, if you look at it mathematically, raising the interest rate actually increases the amount of money that's injected in the economy. The net new money that is injected into the economy is higher when interest rates are higher and lower when interest rates are lower. Because when a bank makes a loan, yes, it charges an interest rate, but the loan creates a deposit, and the deposit pays an interest rate, unless you keep it in checking, but that's a small amount. Most people move their stuff into interest-bearing money market or savings accounts. So that's a wash, basically. Whatever the rate increase by the Fed, so let's say the Fed increases the rates by 2%, the loan rate will go up by around 2%, and the savings interest will go up by around 2%. It happens every time, reliably.
And Treasury bonds obviously go up by 2%. Yeah.
Yes. It depends on the duration of the Treasury bond. If it's a short term, then it just follows. If it's a long term, it's more linked to the expectation of future rate policy, right? Because if it's a 10-year bond, it is influenced by the investors' expectations of all the individual rate hikes in this 10-year period. Correct. So it's an estimation, speculation. So this is why these longer rates are more volatile. They constantly change when the Fed speaks and announces a certain policy. This whole schedule that the market expected can totally change. That's why these rates, the longer term rates, can change a lot. The shorter term rates are more reliable because we know what we know sort of what the Fed is going to do in a month, or actually less than a month now. November.
Probably going to drop a quarter or half point.
That is, yeah. Currently, the betting market is 88% for a quarter drop. So yeah, longer term we don't know, right? It's called the dot plot chart, and we can get into that in more detail. But if you look up dot plot chart, you can see what the betting market is kind of where people are putting their money as to where they're expecting the rates to be. So this is something, just to end this Fed discussion, this is something where we criticize the Fed, creating this whole uncertainty of raising and cutting interest rates all the time, when what they could just do is declare one rate for eternity and never change it.
Be done with it. Yep.
It would increase it would increase stability immensely and predictability of the financial sector incredibly. Because one thing that rate changes do is that they have a huge impact on asset prices. That's not inflation. That's not consumer prices. That's not producer prices. But that's the price of
credit.
The price of future
that it costs to buy that thing. Yeah.
The price of future claims to money. And yeah, with that, the price of credit as well. But basically the price of stocks, the price of bonds, uh, the price of gold actually as well in a roundabout way, which I'll get to in a sec. But when the risk-free rate drops to zero, for example, the proposition to invest in a risky stock is much more feasible than when the risk-free rate is 10%. You know, it's
Right. Yeah.
picking these
Why
extremes.
would I invest in a risky 5% stock when I get a no risk 10%
Exactly.
bond? Yeah.
Unless the stock price adjusts accordingly and it now makes it worth it, right? Now the expected profit per share is 30%, right? Now it makes sense, but the stock price has to come down to justify that. If the stock price, the stock price is, if the long term profit per stock is like 10%, and the long-term rate is 10%, well, then I'll just put it in the long-term risk-free rate is 10%. Then I'll just put it in the long-term risk-free investment asset.
Right.
And
So that's a really good point you made because whether they kept it at 2% or 0% or 5%, whatever they pick, just the fact that it's going to stay there and be stable, we could
yeah,
everybody could just chill out
yeah,
and just know what the interest is.
they could set the rate
Yeah.
to zero. They could set it to 3%, to 2%, whatever it is, 0.25%, and leave it there for eternity. They could set it to zero. They could set it to negative, but that would not be a good idea because that is institutionalized austerity, basically. Because Carlos also mentioned negative rates. I appreciate the response. I heard at one point that the Fed wanted to issue negative rates, whatever that means. Yeah, actually, they did in some countries. In Japan, they went negative, and I believe the European Central Bank also went negative at
That
some
means they
point.
take money out of your account.
Right. So this
Yeah.
means that in the aggregate, the money, the individual savings is depleted over time. So now we have a tax base. The Federal Reserve is taxing the private sector on top of whatever the government is taxing, withdrawing money from the private sector and ushering in a, most likely, depending on fiscal policy, but definitely introducing another lever of austerity for the long term in the economy. So that's really all that negative rates do. But if you're a monetarist, if you believe that rates have an impact on money growth and credit growth, then their belief was they make the rates negative so that the money supply grows and that more people borrow money and all that stuff. But that didn't happen.
Yeah. All
The
you're doing is
opposite
you're
happened.
sucking money out of the system. Yeah.
You're sucking money out of the system. And so now here's the reason. Why don't people borrow more money when rates go negative? Because their incomes decline when rates go negative. When rates go down, the private sector's income goes down. When somebody makes a loan, guess what they look at to decide whether or not you're credit worthy? They look at your income. If you don't qualify with your income, you're not getting the loan. So the current interest rate is much, much less important than the borrower's ability to pay, the borrower's ability to take on the loan. And that is hampered by negative interest rates because in aggregate, it sucks money out of the private sector.